Hi there, Shingirai here again with another update on portfolio performance over the past week. On a one-week basis, we saw portfolio returns ranging from CBAM 1 returning minus 0.32%, down to CBAM 5V2 returning minus 0.83%, in a week where there were very few and far between places to hide in both the equity and the bond markets. In terms of top contributors to performance, we did see a strong performance coming from Hypnosis Investment Songs Trust as the market began to increase some bets on there might be a possibility of that sort of peak in interest rate hikes, and that would see the interest rate sensitive asset up 1.13% on the one-week basis, and also some encouraging macroeconomic data coming out of Europe, leading the LNG European Index Trust up 0.85% on the week, and then that risk on sentiment as we begin to see nothing really breaking in the US economy, and really giving investors some confidence to head further down the credit quality scale and invest some more in SPDR high yield ETF up 0.81%. We continue to see some headwinds for Chinese equity markets, with all three bottom performers on the one-week basis being spread across our three positions in China, across Columbia Threadneedle, Bailey Gifford China, and HSBC MSCI China, down more than 3.7% on the week, on the back of some deterioration in CPI data coming out of China, really raising deflationary concerns for the Chinese market, with the CPI data coming in year on year for the month of July, down 0.3%, alongside producer price inflation down 4.4%, really beginning to irk investors as well. We did see US inflation readings also ticking slightly upwards, alongside jobless claims climbing on the back of last week, and producer prices also climbing in the US, which would increase bets coming into the new week that there would be some argument for the Fed to continue its interest rate hiking cycle. And then we also saw UK GDP for the second quarter surprising on the upside, with some improvement as well for the UK trade balance. In terms of quarter-to-date data, 4 out of 10 of the CBAM portfolios outperformed their respective benchmarks, with returns ranging from CBAM 1 returning 0.12% up to CBAM 4 returning 0.42%. But interestingly here, on a quarter-to-date basis, we did see some confidence returning to Chinese equity markets as investors continue to look for those signs of fiscal stimulus coming out of Beijing, and that would mean on a quarter-to-date basis, our passive HSBC MSCI China position was up 3.12%, and then the FTSE 250 also reflecting some resilience in the UK economy, returning 2.5% on a quarter-to-date basis, and then also seeing some safety there on the shorter end of duration for sterling corporate bonds, up 2.31%. We did see headwinds for the interest rate sensitive iShares Global Clean Energy Fund, down 7.87%, and also JP Morgan Japan down 3.93% on the back of a weakening yen versus sterling. And then we also saw Pictet Clean Energy down 3.88%, and just highlighting here that the iShares Global Clean Energy would be a higher beta play in the clean energy play, and also the Pictet Clean Energy Fund would be actively fund managed, and you would therefore see that dispersion in terms of the performance of both of the clean energy funds on a quarter-to-date basis. Coming into a fresh week, this week we look forward to Japanese GDP, which we saw earlier in the week, coming out up 6% on a year-on-year basis in the second quarter, despite some minor deterioration in the Japanese trade balance. We also saw some bad news continue to roll in from China, despite some action from the People's Bank of China cutting a one-year lending rate in order to as a measure of monetary policy support. But then again, we did see weakness coming from both fixed asset investment and also industrial production, ultimately being the larger stories at play, and that would see about 3 days of Chinese equity markets selling off as well. In terms of UK data, we got average earnings data with earnings for employees coming up 8% on average on a year-on-year basis. But we also saw no change on inflation reading coming from the month of July, which was at 6.9%, matching the June reading. US retail sales improved, and then we also saw some detraction really in jobless claims, which can be taken as positive signs.